Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at DASH, or Dash, that's Dash, or DoorDash Inc. Dash provides restaurant delivery services. The company develops technology to connect customers with merchants through an on-demand food delivery application. Here's the barchart.com technical opinion rating for Dash. The bar chart rating is a 100% buy with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that Dash is well above the moving average line, so the monthly trend in Dash is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started, so the daily trend in Dash is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. Dash is below the upper Keltner channel line, so Dash is inside the buy zone. Since the trend is up, we want to buy a call. Dash has plenty of option chains to choose from. We're going to use the April 19 option chain. Right now, the April 19 options have 55 days to expiration. Here's the Dash option chain for April 19. Dash closed at 121.76 on Friday. That means any calls on the list from 50 to 120 are in the money. Let's take a look at the profit potential for purchasing the 120 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 120 call is 820 to 835. We tried to enter at the midpoint, so we'll use 830 as the buy price. Our call option calculator shows the profit potential for this call based on Dash price changes at option expiration from flat to a 12.5% increase in price. We can see that if the Dash stock price is flat at 121.76 at option expiration, the 120 call will lose 78.7% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 105 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 105 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the Dash stock price is up 1%, the 105 call will lose 4.1% of its value. We want that to be break even or better, so the 105 call does not meet our requirements. Let's see if the 90 call will work. The bid-ask spread for the 90 call is 32.50 to 33.40. We try to enter in the midpoint, so we'll use 32.95 as the buy price. The 90 call works. If the Dash stock price is up 1%, the 90 call will make a 0.1% or $3 profit. That's better than break even, so the 90 call is the one we'll buy. The call option purchase calculator also shows that if the 90 call, whoops, I got lost. If the Dash stock price increases by 2.5%, sorry about that, the 90 call will make a 5.6% or $185 profit. If the Dash stock price increases by 5%, the 90 call will make a 14.9% or $490 profit. If the Dash stock price increases by 7.5%, the 90 call will make a 24.1% or $794 profit. The plus 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the Dash stock price does not make the expected move up and remains flat at expiration, the 90 call would only lose minus 3.6% or minus $119 compared to the minus 78.7% or minus $649 loss for the 120 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the Dash April 19 105 strike call and sell to open the Dash April 19 110 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 105 call for $18.75 and sell the 110 call for $15.15. $18.75 minus $15.15 equals $3.60. So the entry price or debit cost for the spread is $360. The call option spread analysis calculator picture shows that the spread will make a 38.9% or $140 profit if the Dash stock price declines by 7.5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect a $1,515 cash credit to our brokerage account for the sale of the 110 call. As we said on the previous slide, this reduces the cost of entering the spread to $360. Here's a note regarding earnings reports. The next Dash earnings report is scheduled for May 16. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the Dash April 19 90 strike call for $32.95. We also reviewed a spread. The spread said to buy to open the Dash April 19 expiration 105 strike call and sell to open the April 19 110 strike call at a debit of $360. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.